company can report a profit and still feel cash poor. That is the tension long-term investors need to understand. Earnings tell one story. Free cash flow can tell a very different one. The practical question is simple. If you are looking at a company for years, not days, should you care more about accounting earnings or the cash left after the business keeps itself running? The answer is not one or the other. It is knowing what each number is good at, revealing. Earnings are an accounting measure of profit. They try to match revenue with the costs needed to produce that revenue, even when the cash moves at a different time. That makes earnings useful because business activity rarely lines up neatly with the exact day money enters or leaves the bank. Free cash flow is closer to the fuel gauge. It asks how much cash the business generated from operations, after spending on the buildings, equipment, software, or other long-term assets needed to maintain and grow the company. Cash flow is not perfect, but it is harder to pay dividends or reduce debt with accounting profit alone. Imagine a small bakery. It sells $100 of bread today, but half the customers pay later through catering invoices. On the income statement, the bakery may record $100 of revenue. In the cash drawer today, it may only have $50. That timing gap is not fraud or magic. It is accrual accounting. Earnings try to measure economic performance during a period. Cash flow measures actual cash movement during a period. For a healthy business, the two should usually connect over time, but they can diverge sharply in any single year. One reason earnings and free cash flow differ is non-cash expense. Depreciation is the classic example. If a company buys equipment, it may not record the entire cost as an expense immediately. Instead, accounting spreads that cost across the useful life of the asset. Depreciation lowers accounting earnings, but it does not require cash to leave the business that same year. The cash usually left earlier when the asset was purchased. So a capital-heavy company may show lower earnings today because of past spending, while current cash flow looks stronger. This is why investors look beyond operating cash flow. Operating cash flow adds back some non-cash charges, but it does not automatically tell you how much the company must reinvest in long-term assets. Free cash flow subtracts capital expenditures, often called Capex, to bring the picture closer to cash that remains after upkeep. Not all Capex is the same. Some spending keeps the business alive, like replacing worn-out machines. Some spending expands the business, like building a new plant. Financial statements do not always separate these cleanly, so investors have to judge how much cash is truly surplus and how much is needed just to stand still. A common mistake is to say high earnings are good and low free cash flow is bad. Sometimes that is true, but sometimes a growing business is intentionally spending heavily today to create more capacity tomorrow. The question is whether that spending earns attractive returns later. The opposite mistake is treating free cash flow as automatically superior. A company can create high free cash flow for a while by underinvesting. It can delay repairs, cut research, reduce inventory, or squeeze suppliers. That may make the cash number look better now while weakening the business later. If this kind of practical investing framework is useful, consider subscribing. The goal here is not to predict the next stock move. It is to understand the numbers well enough to ask better questions before money is on the line. To compare earnings and free cash flow, follow the route through the financial statements. Start with net income on the income statement. Then move to the cash flow statement, where non-cash charges, working capital changes, and capital expenditures help explain why accounting profit did or did not become cash. Working capital is where many beginners get surprised. A company can record revenue before collecting cash. It can also buy inventory before selling it. If receivables or inventory rise faster than sales, cash can get trapped inside the business, even while earnings look healthy. Some businesses have the opposite advantage. Customers pay quickly while suppliers get paid later. That timing can create strong operating cash flow. It is not free money forever, but it can make the business easier to finance, especially when sales are growing and payment terms remain stable. This leads to a useful phrase: quality of earnings. High quality earnings are more likely to turn into cash without constant adjustments or heroic assumptions. Low quality earnings may depend on aggressive revenue recognition, one-time gains, unusual accounting benefits, or working capital that keeps absorbing cash. Long-term investors usually care less about whether one year looked impressive and more about whether the pattern is repeatable. A legal settlement, asset sale, tax benefit, or temporary cost cut can lift earnings or cash flow once. Business quality shows up when cash generation repeats through normal conditions. Dividends are a good test of the difference. A company declares dividends from corporate resources, not from an earnings headline. If dividends regularly exceed free cash flow, the company may need to use cash reserves, sell assets, issue stock, or borrow money to keep paying. Buybacks are another place where free cash flow matters. Repurchasing shares can benefit remaining shareholders when done with surplus cash at sensible prices. But if buybacks are funded by debt or happen while the core business is starved of investment, the headline shareholder return may hide rising risk. Debt makes the cash question more serious. Interest and principal payments require actual cash. A company can be profitable on paper and still struggle if cash arrives too slowly or capital needs are too heavy. Lenders and shareholders both care about whether cash generation is durable. Some businesses need relatively little physical investment to grow. A software company, marketplace, or brand licensing business may turn a large share of earnings into free cash flow once it reaches scale. That can be powerful, but investors still need to watch competition, customer retention, and stock-based compensation. Other businesses require constant heavy investment. Airlines, manufacturers, utilities, telecom networks, and shipping companies often need expensive assets to operate. Their earnings may look reasonable, but free cash flow can be thin after replacing equipment, maintaining infrastructure, or meeting regulatory requirements. Asset light does not automatically mean good, and asset heavy does not automatically mean bad. The key is return on reinvestment. If a company can put cash back into the business and earn strong returns, lower current free cash flow may be acceptable. If reinvestment earns weak returns, cash disappears without much value creation. Fast growth can hide weak economics. A company may report rising revenue and improving earnings while using more and more cash to fund inventory, customer acquisition, equipment, or credit to customers. Growth is valuable only if it eventually produces cash after the business pays for the growth. For mature companies, the test is different. If growth is modest, investors often expect earnings and free cash flow to track each other more closely over time. Persistent gaps deserve attention. They may point to heavy maintenance needs, weak collections, accounting choices, or a business model that consumes cash. One important caution is that free cash flow is not always presented with one universal formula. Many investors use operating cash flow minus capital expenditures. Companies may also show adjusted versions. That is why the calculation matters more than the label on a slide. Adjustments can be reasonable when they remove unusual items, but they can also make a business look cleaner than it is. If a company repeatedly excludes costs that happen every year, those costs are not unusual for owners. A good habit is to ask whether the adjustment removes noise or removes reality. Stock-based compensation is a common example. It is non-cash when granted, so it can boost operating cash flow compared with earnings. But it still has an economic cost because it can dilute existing shareholders. Free cash flow before considering dilution may look stronger than the owner experience. A useful mental model is a waterfall. At the top is cash from customers. Then come operating costs, taxes, working capital needs, and capital expenditures. What remains can reduce debt, build cash, pay dividends, buy back shares, or fund acquisitions. The lower the water gets, the more real the choices become. This does not mean earnings are useless. Earnings can smooth timing differences and show whether assets are being consumed over time. If a company has strong free cash flow only because it is not replacing aging assets, earnings and depreciation may warn that today's cash number is not sustainable. It also does not mean cash flow tells the whole story. A company can have strong cash flow because it delayed supplier payments or collected old receivables. That can help one period and reverse later. Cash flow is powerful, but it still needs context from the balance sheet and business model. One year can mislead. A better approach is to look across a cycle. Compare cumulative earnings with cumulative free cash flow over several years. If a company reports large profits year after year, but rarely converts them into cash, that gap deserves a careful explanation. Two simple checks can help. Free cash flow margin shows how much of each dollar of sales turns into free cash flow. Cash conversion compares free cash flow with net income. These are not magic rules, but they help reveal whether reported profits are translating into owner-relevant cash. Comparisons work best inside the same industry. A grocery chain, a software platform, a bank, and a railroad have very different cash needs. A free cash flow number that looks weak in one industry may be normal in another. The right question is whether the company is strong relative to its own economics. Over long periods, high-quality businesses often show a pattern. They generate cash through normal operations, reinvest at reasonable returns, maintain a healthy balance sheet, and still have options for owners. The exact mix changes, but the key is flexibility. Free cash flow gives management choices. So when reading a company, start with earnings, then ask how those earnings become cash. Check working capital, Capex, debt needs, dividends, buybacks, and adjustments. Then ask whether the business is building future earning power or simply reporting numbers that look good for the moment. The best takeaway is balanced. Earnings help explain performance. Free cash flow helps test financial reality. Long-term investors should watch both, but pay special attention when they disagree. The disagreement is often where the most important question begins. If you have a question about reading cash flow statements, earnings quality, dividends, buybacks, or another investing concept, leave it in the comments. Your question might become the next explainer topic, and it helps shape videos around the financial decisions people are actually trying to understand.